Thank you, Jalapa. We're in between the group and lunch, which is always a challenge, but we promise to be tasty, not spicy. So, and we're not going to utter the word crypto for those of you who are interested in that. And in contrast to a number of the other panels, this is a pretty positive story. This is one of the areas where I think a lot of very good things are happening in fintech. So we have a great panel, all of whom are grizzled veterans of the fintech small business. Even though I'm the only one who's actually grizzled, they are highly experienced and have been through a lot in the last period in trying to figure out how to make the data revolution help small business lending become more inclusive and better. So before I introduce them, let me just remind everybody why we're here and why this topic matters. Access to fairly priced small business credit is really important in this country because small business is a huge piece of the economy. In recent years, more than 61 million people, almost half of the U.S. workforce, worked in a small business. And small business collectively produced about 43% of U.S. GDP. And even more importantly, small businesses have accounted for 62% of net new job creation since the mid-1990s. It's a notoriously difficult issue for banks. As Karen Mills noted a decade ago, the endless varieties of what constitutes small businesses, high failure rates, and lots of different uses for borrowed funds make it difficult to develop any kind of generalized lending standards. And that has meant that the cost of processing a $100,000 loan is the same as the cost of processing a $1 million loan, and that in turn makes small business lending less profitable. This is a common complaint of the banks. And unlike the consumer area, a consistent credit scoring mechanism has never really been developed that could be used across the industry. And historically, women and minority borrowers continue to be quite disadvantaged in this area. And that's why the emergence of fintech small business lending was so promising. Maybe technology could solve the problem of cost and find a way to expand the types of small businesses that could find reasonably priced credit. And today, we're going to find out how that's all going. So I'm going to let the panelists briefly introduce themselves and talk about what they're currently doing, starting with Todd.
Thank you so much. It's great. First of all, great to be here. My name is Todd Denbo. I lead the commercial team for money at Intuit. And as part of that role, I also lead the small business lending group. And at Intuit, just a little bit of background on Intuit. Intuit has gone through a pretty meaningful transformation over the last decade. And we were traditionally known as an accounting and tax software. And we've really evolved into much more of a global fintech platform. And on the consumer side, we focus on helping consumers with both tax work with TurboTax and Credit Karma. And on the small business side, we've got two major brands called QuickBooks and MailChimp. The mission of the company is to power the prosperity of both consumers and small businesses, and we serve over 100 million of them. And we do this for small businesses really by helping them with a couple key areas in the way they manage their money. Number one, with MailChimp, we help them with their number one biggest problem, which is finding and growing their customer base. And then with QuickBooks, we help them on the financial side with helping them get paid faster. We help them pay their employees with payroll. We help them access and manage capital. And we also help them make sure that their books are done right at the end of the day to prepare for tax time. And one of the unique aspects of Intuit is we actually measure our progress in standing up to this mission. And one of the facts or metrics that we use on the small business front is the 5-year survival rate. And we have a stated goal of making sure that customers that use our products survive at a much higher rate, 10 points higher than the national average. And we actually proud to say that we perform far better than that. 70% of customers that actually use our products to manage their business actually survive beyond 5 years, whereas the national average, sadly, is just 50% of businesses surviving 5 years. And one of the ways that we actually do that is through fueling their business growth with lending. And the way we show up for customers is truly the definition of embedded finance. It's really simple and easy for customers to access credit. It shows up in line in their QuickBooks flow, their QuickBooks experience. And we do it through a combination of direct lending solutions as well as marketplace partners. And that's a little bit about Intuit and myself.
Go ahead, Louis.
Thanks, Todd and Todd. I'm Louis Caditz-Peck. I'm a senior fellow at the Aspen Institute and also a senior fellow at the National Community Reinvestment Coalition. For the sake of clarity with the slide, I do sit on the CFPB's Consumer Advisory Board, but I do not represent the CFPB. I grew up in a family small business, preschools run by my mother and my grandmother, and my professional work started in small business lending and CDFIs, grappling with how there are so many small businesses that they are good credits, they can repay their loans, but they weren't getting served by the traditional banking system very well. And that led to me approaching the fintech company Lending Club and saying, this technology you guys have to lower the cost of originations to make smaller loans more cost effective, that is part of what is needed to fill this market gap in providing access to capital that's needed for small businesses. So I joined Lending Club to spin up that business line at Lending Club, and it grew to, within a short time, over 10,000 small businesses served, 5 times the representation of minority-owned businesses, and 4 times the representation of women-owned businesses as compared to the data that's out there on conventional small business lending until the 1071 data starts to come out. And very proud that grew into a partnership with the CDFI Axion Opportunity Fund, and of course, Lending Club is still making small business loans too, as SBA loans. And I also am a co-founder of the Responsible Business Lending Coalition and the Marketplace Lending Association and the American Fintech Council. And really happy to be here and talk with these folks.
Thanks, Louis. Worked with these guys previously, so it's a bit of a reunion. And thanks, Todd. So I'm Steve Allocca. I lead Funding Circle US, which is a leading online small business lender. I've lent to about more than $5 billion in the US and more than $20 billion globally. And what's really unique about Funding Circle is Funding Circle's cracked the code on making efficiently and effectively underwriting and making loans to relatively larger loan sizes in the digital space. So loans up to $500,000. This is an area that historically has been very, very difficult to crack, to efficiently be able to combine manual underwriting with as much automation as possible to make it efficient. Funding Circle's really cracked the code on that. And I think it's really, really important because what that capability enables us to be able to do is really start to make much more clear the link between a business's cash flow and their financial health and their access to capital and borrowing at the lowest possible cost. And I think this really, really matters a lot. I started my own small business. I've talked to countless small business owners, and I feel that having confidence, having transparency into the things that you can do, the decisions you can make, and the actions you can take to improve your cash flow, and therefore the sustainability and scalability of your business is probably the single biggest thing we can do to drive productivity, to drive ultimately, small business owners' confidence, and therefore, the U.S. economy, as Todd mentioned, and ultimately, confidence in the American dream. So innovation. I think it's really that important. What's led me to that belief is, a 30-year career that spanned financial services, starting actually at the summer internship while I was in college at the Richmond Federal Reserve Bank, really sparked my interest in this space about how can we better leverage data and technology to help people make better decisions about their money. After the Fed, I started out in traditional banking. I spent the first half of my career in traditional banking at 2 money center banks, including Wells Fargo, where I saw firsthand the distance between the aspiration of the company to help customers succeed financially and what actually motivated decisions, including referring to small and medium-sized businesses as the invisible middle, because it was just too expensive to try to serve them. So kind of didn't really try. So after that, I shifted over to what we now call fintech. I founded a company in 2008 and still serve on the board of what was a very small company, now a little bit bigger, that uses data and technology to provide better risk management solutions to the very broken student lending space. It's a whole other topic we can I'd be happy to talk to anybody about another day. But then after that, went to PayPal, ran PayPal's credit business, data science for PayPal, and part of the payments business, including PayPal Working Capital, which is PayPal's small business lending business, became the fastest growing business within PayPal. And then after that, I spent 3 years as president of Lending Club, culminating in Lending Club buying Radius Bank and sparking what is now hopefully a trend of fintechs coming together with banks. And then most recently was chief operating officer of a company called Bluevine. Bluevine was a small business lending company that offered a small business checking account just over about 2 years ago. And that small business checking account has grown to just under $1 billion in deposits today. So all of that experience collectively, number one, brought me to the funding circle, but more importantly, brought me to this belief that now is the time that we can provide a much, much clearer picture for small business owners and entrepreneurs about the decisions they can make that impact their cash flow and ultimately the sustainability and scalability of their business. And I really think there's not much more that we can do that'll be more important for all of us as a society.
I'm Luke Voiles. I'm the CEO of Pipe. Pipe is an embedded financial services company, financial services technology company that helps small businesses get access to capital from directly within the software they use every day to run their business. Just going back to what Vice Chair Barr said this morning about him personally being a technology company first, I think it's actually true. Like, he carries around an iPhone in his pocket. He uses Zoom to run his business. There is software and tools that he uses to actually live his day-to-day life. Same thing for all of these tiny small businesses and even big small businesses out there, where Toast, for example, handled restaurants from a vertical perspective. You now have companies like Slice that are focused on just pizza shops. And so all of these SaaS vertical solving the pain point of a very specific industry, is turning all of these small businesses into technology companies first, because they can use a single software instance to run their entire business end to end. And so what Pipe is doing is partnering with those SaaS vertical businesses to enable them to deploy capital to their small business customers, leveraging all of the real-time transaction data and payments data that is present within those software stacks. So it truly is the future of small business lending. I had, I guess, really two careers so far in my past. So my first career was as a distressed credit special situations investor at a big private equity fund, or several of them. The last one I was at was TPG Capital, working with the Sixth Street Partners team, and we deployed billions of dollars trying to help banks unload assets from their balance sheets during and after the global financial crisis. So I think I probably didn't have a Thanksgiving or a Christmas with my family for 6 or 7 years because the banks needed to unload the assets before the end of the year every time. So a lot of time on the credit side before switching over to fintech. And so my second career really was actually went to Intuit to build the QuickBooks Capital lending business from scratch. So there was already a marketplace, but we decided that the other lenders on the marketplace weren't using the data, including Funding Circle, to using the data from within Intuit to underwrite those businesses. And so we started and built a brand new credit policy and model that worked based on the 26 billion transactions that are in the accounting software and the 26 billion bank transactions. And now it's going amazingly. I'm very proud of what the team built, and I'm excited, Todd, that you're there still driving it. After Intuit, I went to Square. And so at Square, I led the Square banking team, which was Square Capital. It was the checking account and debit card, Square Savings business. We were really including instant transfer. We were 4 products in the US at scale. We were also in Canada, UK, Australia at the time. So that was a pretty amazing experience on product velocity. Like, Square is very good at building stuff fast and making things happen quickly. And so credit career, tech career, Both of those things individually are extremely difficult to get right. And when you combine the two things, it's even more complicated. The matrix just gets nuts. And so my whole career has really been in and around kind of small business and consumer credit and now technology. And I'm excited to take all that to Pipe to help all these small businesses that frankly don't have access to capital. And as you said, Todd, the stats from Square are pretty telling, right? They do $5 billion a year in loan volume, and 51% of the loans go to women-owned businesses. 32% go to minority-owned businesses, and many are thin file from a FICO perspective. Those customers just don't have access elsewhere. But Square is able to underwrite with only the payments data. Like, that's it. I was dumbfounded when I got there. There's no FICO score getting pulled. There's no bank data getting pulled. There's no commercial scores getting pulled. It is literally just the payments transaction data that you need to underwrite those customers. And so it's a very powerful way to open access, and Pipe's model will be very similar to the Square Capital model and PayPal Working Capital and Stripe Capital. And many of the other larger ISVs or software verticals are doing the same type of lending.
Yeah, this is all about using new data sources to change outcomes. So let me start with a general question. I'll direct it to Todd, but others can comment. So how much credit expansion is really happening as Fintech has promised it would do? And what data sources is Intuit using that others aren't, and how scalable is the whole activity?
Great question. And I think the answer is that fintechs have done a great job expanding access to credit, and part of the reason is crystal clear when you put yourself in the shoes of most small business owners. Most small business owners want to spend 99.99% of their time running their business. They don't want to spend, their time applying for credit, and frankly, just going through that process generates fear and anxiety of being judged. And so when you look at the way most fintechs have really architected their value proposition, it's all around speed, right? Speed of decisions and speed of funding and simplicity of the application. And so when you combine that value proposition with data, and you look at companies like Amazon and Square, like Luke just mentioned, PayPal, where you've got much more robust insights on the customer beyond just traditional credit scores, you can really pay off that value proposition. And at Intuit, what's interesting is because many of our customers are doing their accounting with us, we have real-time insights into their cash flows. And additionally, whether their trends on employees are going up or down, or sales and marketing is going up and down, and we can effectively take that surround sound insight and pay it off in opening our credit box. And so what's interesting is if you look at most traditional banks require a small business to have been in business for 2 to 3 years before they'll even consider taking an application for credit. Whereas companies like ours, because of the more real-time surround sound view of that business, we can make loans to companies that have only been in business for 3 months or 6 months, far earlier in their life cycle. And so we actually also survey customers frequently to really understand whether they had other options elsewhere, just so we can have a good sense of temperature of the market. And the number oscillates between 20 and 50% of our own customers that say that they weren't able to get credit elsewhere. And part of the reason that we're able to do that is really the experience and the data.
Great. Luke, let me ask you, obviously you've been a pioneer in using alternative data sources. What do you think are the pros and cons of the different types of alternative data that's available now for small businesses? And is this evolving towards some type of, super small business credit score, or is it always going to be a combination of different sources?
Like small business lending is complicated just given the different lending products, right? If you look at the Square style or PayPal Working Capital style, where it is revenue-based financing, right? You take 6 months of historical transaction data from payments. You can very accurately, through machine learning models, predict what the next 12 months looks like, and you give them about 10% of what you expect them to make in revenue through card processing over the next year. And then you can hold, in a priority position from a credit perspective, you can hold that. that's the only data you need to do the underwrite. Like the machine learning models are so accurate, and you're first in line on the cash flows themselves that it doesn't matter what the expenses are. And so the problems that Intuit solves by creating really a debt service coverage ratio style underwrite where you had to know what the expenses were accurately to make sure that the customer could afford to pay you back. They were making enough cash flow to actually go. That's a different data set that's more challenging to work with. So Intuit has a huge advantage on the expense side. And I think Funding Circle has been trying to figure out how to get the expenses too over time. But it just works. The data works so well. And so we're trying to at Pipe expand beyond just the large like PayPal and Stripe and Squares of the world that are doing this to all of these other smaller companies that are providing software for small businesses. That data just works so well. I think it shows in the numbers too with the access that it's opening up.
So one of the other things just to keep people in mind here is in the traditional underwriting process, you're asking people what their income is. There's fraudulent activity. There's all kinds of things. None of that matters here, and that's why the cost can be reduced because real time Intuit's seeing the P&L. Real time Pipe is seeing flows through the payments pipes, and it really does allow for a significantly cheaper process, which has always been the Achilles heel of that small business space, it was too expensive relative to the size of the loans. Louis, you want to comment on that?
Thanks, Todd. I'd like to underscore something that Luke said about the value of adding that expense data to the equation. Harkening back to yesterday, Director Chopra talked about his hope that technology can sort of bring us back to the fundamentals of underwriting and ability to repay, and that's what Luke was describing with the debt service coverage ratio kind of underwriting that Todd at Intuit is doing with their surround sound data. I have concerns, and I think they're about an underwriting style that's based only on a business's revenue stream without looking at expenses. If you don't know the expenses of the borrower, I don't know how you can really assess if they have the ability to repay. And I think that's connected to just a couple years ago on the stage, Federal Reserve President Harker said, and I wrote down his quote to make sure I don't misquote him. He said, I hear these stories constantly about a small business in particular that's getting into a situation where they didn't quite know what they signed up for. And they walk into their community bank and they say, I've got to get out of this. It's killing me. And so there are good and bad actors. And I think on stage here, we've got some great examples of good actors. And, as another example, there's a great research study answering Todd's earlier question about financial inclusion where our conference organizer, Jalapa Chaktiani, looked at data from Funding Circle and also from Lending Club and found that over time, the underwriting was getting further away from traditional credit scores, but also getting more accurate. And that's really exciting. And that's this bright hope we're looking at. But I also want to try to blow some of the smoke away because I think when we're talking about underwriting, this is only a really small part of how risk mitigation is happening now because the products have changed so much. What you see in the story that Jalapa's research about Funding Circle tells is a story that we look to wanting to see a lot of places in how underwriting improves. Can new data make our underwriting more predictive of risk that would allow us to charge lower prices and expand access without expanding losses? And when this can happen, it's really wonderful. A lot of what I think is the innovation is really changing small business lending the most, and I think we'll hear a lot on this panel, is changes in how customer acquisition is working, because that turns out to be the hardest part of small business lending. And that's accompanied by other ways of mitigating risk, which have tended to be across the market, sometimes just charging APRs that are 50% or 100% or 150% as a way to deal with risk, shortening the terms of repayment so that the lender has less exposure to the borrower, and that can be appropriate. It can be a problem when there's a business model, which is quite common across even very large tech companies, of having customers use expensive short-term credit on a long-term ongoing basis. I think you can see we've sort of swerved a little bit from the tasty, maybe into the a little bit spicy side of tasty. I don't know. And then another one of the major innovations that I think has to be part of the conversation about risk mitigation is the payments mechanisms have really changed of how small businesses repay their credit. You know, if you get a loan from Funding Circle, you have to pay Funding Circle once a month. And so if you as a small business, after you pay your payroll, after you pay your rent, after you deal with that expense side of the equation, if you don't have enough money to pay Funding Circle doesn't get paid. And so there's a natural alignment of incentives that happens there between Steve's business and the small business owner's best interests. And a lot of how small business risk mitigation is working now isn't necessarily through better underwriting, but it's through having a privileged repayment mechanism so that when a customer of a small business pays that small business, if that payment goes through some kind of online payment processing rail that then gets diverted to pay the lender before the money goes to the borrower, the lender gets paid before the small business gets paid. So they can make money and be whole whether or not the small business actually had the ability to repay. And that's not necessarily a bad thing in of itself. You can still lend responsibly that way for sure. But it does create a certain kind of moral hazard to make sure that the lender is paying attention to ability to repay in a way that their business model maybe doesn't really force them to. And I think that question of aligning interests is got to be a really central one as we think about how underwriting is evolving.
So that's, a good point, Louis. You see this model sometimes in other parts of fintech. It's behind the earned wage access cost advantage. But the real question is whether that payment priority translates into lower risk and lower rates. If it does, we're probably all winners. Although I take your point about lack of visibility. So
can I just respond
sure.
to that one? Yeah. I mean, the answer is it does. Like the stats that I shared about Square doing 51% to women-owned business and 32% to minority, like that's only possible because the structural security you get from being in the flow of cash, right? And because if those customers don't have FICO scores, like I don't want to be the one to tell them, sorry, you can't have this, right? And if you do the models the right way and have the right protections for the customers that run into trouble, like you can't 100% with 100% accuracy predict for 1,000 borrowers which one will be able to pay you back, right? You can predict on a portfolio level what's going to happen, and those that can't, you need to have the ability to like take a break from making payments. And the friendly versions of these products say, hey, our contract actually lets you do a pause for a month or for 2 months, and if you have even more trouble, give us a call and we'll pause it for longer than that. The other part that the feature of the product that's good is that it's tied to revenue. So if your revenue is down 50%, you're paying 50% less. And so the product recommendation score is in the 80s for these types of products because it's so easy to get and so easy to use, that it's just an automatic payment. So you don't have to think about it. And so my strong perspective is that the benefits of these products and opening up like access to capital outweigh the risks as long as you have the right protections in place for those that do get into trouble and have the right friendly protections in those products.
Okay. So, we heard from Director Chopra and from others that, the 1033 open banking process is moving along. I wanted to ask Steve, Intuit and Square and PayPal to some degree are sort of walled data gardens. And how do you feel about a system that's based on those gardens? It feels a little bit like the discussion about Apple and Google as well, as opposed to a more open data environment that presumably is something that Funding Circle would take advantage of.
Yeah, it's a great question, Todd, and I can see both sides of this. And so first, acknowledge. Look, what Luke mentioned. The ability to be able to execute what is a brilliant business model, having a payment facilitator be the source of making loans to its customers, where you have almost perfect information coming in, and you stand at the front of the payment, and you have practically no customer acquisition cost. It's the reason I left running the company that I started in 2008 to go to PayPal to start that business, because I said this is a no-brainer business model. But in a sense, what to me is at the heart of this question is credit is really complex. But on the other hand, it's actually not that complex. Credit has been underwritten the same way for centuries. There's 5 C's of credit, right? And the middle three C's get to ability to pay, what Director Chopra talked about yesterday. It's capacity, it's cash flow in, less cash flow out, what's left over. It's capital, it's how that cash flow left over accumulates and results in accumulated net assets to repay, and then collateral, which are, not liquid assets that could be sold to become liquid assets that gives you an ability to pay back, right? So what's driven most of the innovation around credit decisioning in all of our lifetimes has not been about trying to get better at ability to pay, at measuring ability to pay. It's been entirely about becoming more efficient, like Todd mentioned, right? Because efficiency, credit's a profitable business if you can underwrite efficiently. So, credit scoring, using bureau data to be able to then develop models that for prime customers, like Ken Lin of Credit Karma talked about yesterday, incredibly predictive. It's not broken. Why fix it? You can use credit bureau data. They can very accurately predict credit risk. Why would you fix it? You don't have a problem that's broken. Why fix it? Right? Same thing with payment facilitator data that's getting perfect access to revenue data for the company. It's extremely, like Luke said, it's extremely predictive. The problem is it doesn't predict ability to pay. Payment facilitator data with revenue does a much better job of credit bureau data. Credit bureau data doesn't tell you anything about ability to pay. It's a lagging indicator, right? It tells you nothing about the three C's of credit that I mentioned. It tells you nothing about a business's capacity. It tells you nothing about their capital. It tells you nothing about their collateral. You can impute some of those things indirectly, but it doesn't tell you anything about it. So to me, look, leveraging efficiency to drive innovation in credit decisioning that has the outcome of making credit available at lower cost to more individuals and consumers, it's great. It drives the economy, no doubt about it. But how much better would it be if we actually leverage this nearly perfect information that we all have now because we carry a supercomputer in our pockets to be able to actually measure and track ability to pay? That's, to me, that's the next frontier. And it's not going to stop this brilliant business model like Luke's from proliferating and profiting and growing spectacularly over time. But to me, the bigger problem that we can all solve that's going to make a bigger impact on the economy is actually using the data and the technology we have to be able to create models, and maybe not even models, maybe just an accurate, validated reflection of how much money you've got coming in, how much money you've got going out, how much money is left over, how much money you've accumulated, and how many assets you've accumulated. If you had a perfectly vivid picture of that, I would argue the rest of this stuff, it doesn't matter.
Interesting. So, do you think there's a role for intermediaries? We've seen, Plaid take a major role intermediating in the consumer space, and I know they are doing a lot of the small business as well. Is there a sense that individual companies are going to develop this capability, or is it going to be some type of intermediary or utility along the lines of the credit bureaus or somebody like Plaid? Anybody have a view on that?
I mean, like Intuit has commercial credit scores now that work better than anything that's available out there based on the enormous data set they have. It's possible that they'll decide to become a CRA one day and actually make it available. I'm just going to speak out loud for strategy stuff that we were thinking about a long time ago, but it's possible. Just going back just real quick to your point about like walled garden, like one simple example to show why it's not that big of a risk in this space is that imagine a pizza shop that uses software called Slice to run their business. They're in there every single day, like doing deliveries, making things happen. They could get a loan from Pipe. Because we have the payments data, can see all the cash flows coming in through the revenue, and then at the end of the week or at the end of every day, when they pull they pull their bank data into it to do their accounting, like they're in there once a week probably making sure that the stuff's working the right way. Like all of these businesses can use multiple tools to run their businesses. I don't think anybody has a lock on the data sets. It really is the transaction data that's moving. And then just to the Plaid point, it is a known unknown, whether you have all of the data or not, right? And so when a customer links their bank account and you look at all this revenue and all these expenses coming in, there's no way to know whether that is all the revenue or that is all the expenses unless you ask them to input the data, say, yes, I do make $1 million a month in revenue, and this is all my transactions. So it's really hard to actually, from a data perspective, know whether you see the full picture, because they could just have all their expenses running in another account and not connect it, and your debt service coverage ratio calculation is just wrong. But that's it.
Yeah, absolutely. So, Luke, to follow up on that a little bit, your business is very focused on this concept of industry verticals being the future. And as we know, small business is incredibly diverse. It's an ice cream store, it's a shoe store, it's all kinds of different things. So how do you view that in terms of how you're driving your business? And is it helping you, obviously in the customer acquisition area, but how is it beyond just pure credit analysis helping you, build that business more effectively?
I think when you're doing a startup, it helps a lot to just narrow your focus as much as possible to problems that you think you can solve. Like, lesson from Scott Cook at Intuit, unbelievable figure, like follow me home stories, like knowing exactly what your customer is doing in your product every single day, and literally like following them home from buying a shrink wrap package of like 3.5-inch floppies of Quicken and saying, hey, can I actually watch you install this and watch you connect your accounts? Like that customer focus and solving the pain points, I do not think can be done horizontally anymore. I think that the pizza shop owner that has very specific problems when they run their business needs an entire company that's focused only on solving those pain points. And on the other side, embedded financial services is really dang hard. Like, to do lending from a risk perspective and a regulatory perspective the right way is very difficult to do. And I don't think any of these software vertical focused businesses have any business doing that. And so there's a real reason for embedded financial services companies to then provide the horizontal financial services for the verticals, because we each specialize in our own specific thing. And then when you think about the data we've narrowed to and the product we've narrowed to, it simplifies the data problem dramatically when you don't have to worry about what expenses are and you still can open up access to capital. So it's a bit of letting the people focused on the right pain points solve the problems, letting us focus on the embedded financial services problems, and then narrowing the data sets to where it already works, where product market fit is there, and just focus.
Can I jump in just for a second there? I think there's a role for both of these, and it does come down to the consumer perspective, a small business owner perspective, and there's a big role for brand and trust. And when you're sharing and using multiple services, I think there are some SMB owners that are comfortable sharing their data on multiple platforms. And there are going to be some that are very interested in concentrating and simplifying their lives on a single platform with a brand that they trust. But I think the core element is going to be trust.
Related to what Todd said, I just want to mention something that I think is worth raising about this walled garden conversation, that something Intuit is doing that I think they deserve praise for, because it's brave, is they have priority access to all these customers, and they have a great internal financing product, but they also create a marketplace where those customers have exposure to the financing offered by other companies. And that gives consumers a sort of optionality and creates some competition and choice that I think is sort of a hopeful direction for the future, relative to one where everyone gets trapped. So, props.
Okay. I have to respond to that really quickly. I think that comes down to having a long-term mission of helping small businesses. And if we can't be the lender of choice, and somebody else can do it better, that's core to our mission.
Yeah, and that's the Scott Cook customer focus, coming back in. So a subject that interests me a little bit is this, the whole question of how small business gets funded. And there was a recent study showing that in the consumer lending space, the investors out there were not giving effectively credit on the pricing to alternative underwriting methods. They were still looking at the FICO score and doing it based on that. Is that something that you perceive as being a long-term problem for the, financing side of business? Anyone can comment.
It's a limitation. I'll start. It's certainly a limitation. At Lending Club, we worked with a couple of asset management companies, really acting more like hedge funds, that would fund loans using non-traditional data and non-traditional methods. So Stone Ridge and Pagaya, because that was part of their business model. But it was really only at the fringe like that you'd get access to funding for a non-balance sheet, a non-bank lender to be able to really innovate and make loans other than on that company's balance sheet. What we do at Funding Circle, what I did at Bluevine, what I did at Lending Club, and certainly at PayPal was all on balance sheet. So it was really difficult to find external investors that would give you credit for those things that were, non-traditional. And it's one of the things that creates this opportunity uniquely, I think, in the small business space. If you listened to Ken Lin yesterday, every time he talked about the effectiveness of FICO, every single time he said consumer. In the small business space, if you're underwriting the right way, you're not using just bureau data. At Funding Circle, 50% of our decisioning is using tax data and cash flow data, so non-bureau data. And our internal analysis shows that we're 4.5 to 5 times more effective predicting credit risk using that data than using the bureau data alone. So in the small business space, uniquely, unlike consumer, where, like you heard from Ken yesterday, it's working really well. So it's hard to innovate. It's hard to get investors to pay attention to something that's not bureau data based and not FICO based, because that's working really well, especially for the prime space. But in the small business area, that's not the case at all. So it gives us the opportunity to be able to really be innovative in how we use non-bureau data to make loans. But the funding, the funding situation is a constraint.
Wall Street's not so up to it. Your view, Luke?
Yeah, I think that from a balance sheet perspective, there are lender finance banks, so the largest banks in the U.S. are actively lending to specialty finance companies, like some of these on the page. Specialty finance has been around for decades, for 100 years. This is adding technology to it doesn't change it, but you can get a 70 or 80% advance rate from a big bank because you have equity from your own balance sheet protecting the bank in case there's losses. So losses can go up 4 or 5 or 6x before the bank loses money. On the small business side, there are very few products where loan buyers are willing to buy the entire risk from you and not have equity protecting you. The merchant finance product that PayPal and Stripe and Square do is one of those. You can sell those for way above par, and operate in a balance sheet light manner. And so it comes down to just the specifics of the individual products and the data advantages and the structural seniority and the cash flows you have, to where you can create products that actually can be sold in whole loan form, and have someone else take all of the risk, and then a bank will come in behind that whole loan buyer and back lever them to get them an even higher yield. So certain products are getting a ton of depth, and there's so much demand for the Stripe, Square, PayPal type risk that some of the big banks aren't playing because they can't get enough volume to make it make sense. And so they're waiting in the wings to do more of this. So together, using the balance sheets of the big banks to then be protected. This goes to the narrow-ish bank idea, where the big banks can actually help us deploy capital to these businesses by doing a 70 or 80% advance rate, letting us interface directly and handle the risk, sourcing through software companies, because every small business absolutely is a technology company now.
I would add that one of the challenges is just time. Most investors want a couple of years and large data tapes before they can really understand how new variables are performing over time. And so that's one of the biggest challenges. And they'll peg usually to a known quantity like FICO to effectively better understand the portfolio or the originations tranche. So I think time is really the challenge with some of the data that folks are using.
Okay, so I'm going to flip over slightly. This area has long used machine learning and what was previously called AI in pretty much everything they're doing using alternative data. Generative AI is a new thing, or at least a new thing in its public introduction. Is that going to make a difference, an additional difference? Is it really meaningful at all in the context of this, or do the more traditional machine learning algorithms really do what's necessary?
I can start if we want. At PayPal, what we did is we used machine learning extensively to make credit decisions. And what we had to do, if you listened to Director Chopra yesterday, if your algorithm can't explain to a customer why your model spit out a no, you can't use it. So what we did at PayPal is we developed algorithms on the algorithms to be able to give those adverse action reasons. And it worked. It was effective. To me, though, that's still not as good as the next step, which is can we clarify for a borrower that direct link between their ability to pay and their access to capital that's reasonably priced. So it's I think we're in the early stages of the journey still, but I can imagine a world where we're using Gen AI not so much to make the credit decision, but more when the credit decision is a direct link back to the decisions that a business owner can make and the actions that they can take to be able to generate additional cash flow, increase revenue, decrease expenses, accumulate more cash, or protect the things that could disrupt the cash. If we can create more of a direct link between that and what they really care about a lot, which is access to low-priced capital, then I think they're going to be equipped to make better decisions, and they'll be welcoming the advances that Gen I can bring to bring them better recommendations of the things that they can do that are actually going to improve their business financial health and therefore directly linked access to credit.
Anybody else?
I mean, I can always pile on. This is one where if you claim that your underwriting and your decisioning is 100% controlled by just one machine learning model, it's just not, like, you just don't understand credit strategy, right? It just doesn't make sense. And so you can use a gradient boost machine learning model to predict revenue based on 6 months of transaction data. That is simply an element or an attribute that then you put into a scorecard based credit policy that says, okay, that just helps me size the loan. But if they have less than 10,000 of expected, then it just gets kicked out. There's a bunch of kick out rules, right? And so the Shapley, like the model on top of the model, I think is probably Shapley, where you can cut a hole or a window into the black box model to see the whys. But I think it's just more complicated than that. They're like each attribute you can use machine learning models to figure out, like the credit score. Like the attribute is, what is the probability that they default in the next 18 months? What is the predictability? Like what is the revenue expected in the next 12? Like those should go into a scorecard type model that helps you make a decision, and you will always know why that decision was made. It's because the parts didn't fit the policy that like a human can actually read and understand. And so like, I don't think it's a good idea to have machine learning do it. I think this actually goes back to what Ken said yesterday, Ken Lim at Credit Karma. I actually disagree on the credit score part that he said at the end of his session, because I don't think it actually worked. All the stimulus dollars that came in, a couple of consumer lenders claimed to use machine learning models, and all those machine learning models thought, you know what, like income just went up. And so all these credit scores went up. So yeah, maybe individually those credit scores were accurate, but people shifted from one score level to another. So they went from 650 to 720 when they actually performed like a 650. And so when like the score caught up later, and this is where machine learning is not going to have the grizzled credit veteran thoughts. Like that just doesn't make sense. Like you shouldn't do that because it's different this time. And machine learning can never understand that it's actually different this time. ChatGPT can't predict what is different this time. Like I can go on forever. There was an interesting thing that I saw posted where ChatGPT tried to answer the questions for a CEO in an earnings call based on all the past earnings calls. And it did great for any type of scenario that was the same as the past, but it's never the same as the past. And so I don't think it's ever going to work in that sense.
That's a fundamental weakness of that whole model. So lightning round here. We're going to switch to regulation briefly. 1071, good thing or bad thing? All right. What do you say? Start with you.
Good thing. I think for companies like Intuit, where we're opening up access to far earlier stage companies, I think 1071 is a good thing.
Yeah, good. Louis?
1071 is going to show that traditional small businesses have been not doing a very good job in reaching women and minority-owned businesses, and that the folks on this stage are doing a good job. And that's going to create a lot of opportunity for fintech as banks realize they need to partner with these folks and others to get the capital that they should be getting to smaller businesses and women and minority-owned businesses.
Okay, Steve?
Great thing for all the reasons previously mentioned. It's a difficult thing for fintechs to do anything that's going to introduce incremental friction in a transaction, because fintechs compete against banks that have a lower cost of capital and lower customer acquisition costs by simplicity and ease. So yeah, really, really difficult to, if we're going to be the first ones to go and add additional friction by asking customers additional questions. Why do you want to know my gender? Why do you want to know my ethnicity? Right? That's going to be a difficult thing for a fintech to do. But seeing the bigger picture, it's absolutely, like Lewis said, it's going to show what we already know, which is we're providing capital to those people who are not being served well by the banks. And that's why I wish everybody would just get on board with this, make the rule, make everybody have to adopt it right away, and we'll have a better world as a result, rather than arguing about it.
I'm all for it as well. Like, it's just going to help us show that we can do better than the banks in all these areas.
Okay, so second one. Should the Truth in Lending Act apply to small business?
Yes.
Yeah.
Clarity. Clarity is a good thing. All right. There's a complex enough space that abiding by a single rule of clarity would tremendously help.
And Intuit famously posts APRs even on products that don't require it, right?
Funding Circle does too. Just to illustrate this, I think I'll just share some experience from Lending Club. So when we designed that, our strategy for lending, part of that strategy was to be the lowest cost provider online to a given small business. And what we found is that in the market today, that is actually a very difficult strategy, because our customers could not tell that our products were lower priced than our competitors, because we were transparently disclosing APRs. And the prevailing market practice in states that haven't yet passed a real small business truth in lending law that has APR is to disclose some kind of invented percentage numbers that kind of look and feel like APR. And Fed research shows that small business owners think those percentage numbers are APR. So we're out there trying to say, hey, Todd, great news. We can improve your business. We can give you an APR of 20%. You know, you're a small business, but that's okay for that market. And Todd, and I just watch this happen every day, would be saying, you know, he would say, well, such and such company says they can give me a rate of 10%. And then our sales guy would be like, well, what is that rate? Turns out that rate is just some percentage number. The actual APR equivalent might be 60%, and we're offering 20%, but the customer doesn't know. And so until there's price disclosure, you can't have price competition. And until there's actual price competition, you can't have real innovation that's driving prices down. At the beginning, Todd talked about how customers really want speed and ease in small business financing. And those are really, really important. But what you're seeing in the market today is that's kind of all small business financing online has to compete on. They don't have to compete on price, because they don't have to disclose prices in a way where customers are able to compare prices. So this is a broken market, and there's an opportunity to just change the rules of the market that lead to real innovation that rewards stuff like what Funding Circle's doing and what Intuit's doing, and the stuff that Luke is starting to do at Pipe that are able to drive down the cost of credit for small businesses.
So we're at our appointed time. And I want to thank the panel for a great experience. And I want to thank Jalapa again for this conference and the Philadelphia Fed. But thank you very much, and off to lunch.